Hi, everyone. This is Josh Nelson. We're going to get started here in just a few minutes. It is about 12:26 right now. We're going to get going right at 12:30. So go ahead and get your beverage, get ready, and we'll get started here in just a few minutes. All right, and as people continue to sign in here, we're going to give people a few more minutes and start right at 12:30 today. We want to respect everybody's time. We know, especially this time of year when Christmas is upon us, that people are very, very busy. So I will get started right at 12:30, so we have plenty of time to get into the material and get you on your way. While we're waiting, we've got a couple of minutes. We've got a couple of features that GoToWebinar has that can be helpful with communicating with me. One of those is there's a questions box, and feel free to type in questions along the way. If you think of something, just type it in, and I will try to catch them as we go. If not, I'll catch them at the end. So we will have some time at the end for question and the answer. The other thing that we have is we have a chat feature. And if you just want to say hi or give me any comments or go Josh or something like that along the way, that's always fun. So please feel free to use the chat feature. So you've got chat, questions, and hopefully everybody can hear me and see my screen. So give people about a minute and a half here and we'll get started. This is very timely because right now there are some moves still that can be made before the end of the year. That's why we wanted to do this seminar now, because you still have time. So we'll give people one more minute and then we'll get signed in. While we're waiting here, actually, I see a few people that have just joined us. If somebody could do me a favor, just to make sure that we all know where stuff is, could somebody type something into the chat feature and into the questions feature? That way I know that you can see those tools and we're able to communicate with each other along the way. All right, good deal. Thanks, Austin. Saw the question come through. All right, and it's 12:30 right now, so let's go ahead and get started. I'll go ahead and turn on my webcam, at least for a moment, so you can see me. And dialing in here from Loveland, Colorado. I know some people are dialing in from around the country. We've got a lot of clients here in northern Colorado, but equally we have clients that are kind of all over the world, depending on where they're traveling to, right? And some of our clients have moved on. They've gone to other places to work, to California, Florida, Washington State, just all over the place. It's kind of fun, obviously, that people get to travel and they get to have second homes and things like that. So feel free to continue to dial into these, because this is our way of being able to reach everybody, regardless of where you are. And it's also useful because you don't have to be here live. It's useful, right, because you can ask questions, but we actually have more people, more clients and prospective clients that end up tuning into these on the recorded version after the fact than who attend live. So glad you're here today. Today we're going to talk about taxes. As we get started, for those of you who don't know me, I'm Josh Nelson. I'm a certified financial planner. And basically what that means is that I've had to go through an awful lot of experience, passed a really hard test, gone through a lot of education, but more importantly, I've had to go through a lot of practical experience with helping people not only in good times, but in a lot of really rough scenarios through going through the death of a spouse or a loved one, going through a job change or a forced retirement. So it's not when things are going well that we're really tested. It's when things don't go so well and we get to figure out really if we've got what it takes to be able to make it through that. I can tell you that I've been through two of the worst bear markets ever, and hopefully we're not headed into one anytime soon, but we had one from 2000 to 2002 and 2008, 2009. With all the market volatility this year, the one topic that we don't want to get crowded out is taxes, and that's what we're going to talk about today. So with that, again, we've got a question feature, we've got a chat feature. Glad that you've all dialed into us today. I'm going to respect your time and get right into the content. And along the way, please feel free to ask questions, put things into the chat feature. I'll try to catch them as we go. And if I don't catch them as we go, I'll be checking it at the end to make sure that I answer any questions. I want to make sure that this is really valuable to you. I know you're giving up part of your lunch hour and during a very, very busy time of year. So I want to respect that and make sure that you get as much value as possible out of our discussion today. So I'm going to go ahead and shut off my camera for right now, but I'm here, don't worry. And we'll go ahead and jump into the actual content. So I think taxes are really interesting. I think that tax changes, especially this past year, have been probably greater than I've ever seen in my career, probably rivaled by 2001. There was a big tax bill that passed that year, but it did change a lot of the rules that we were used to using in the past. So again, I think that's fun, right? Because I'm a financial planner. I think it's fun when things change and now we have to re-strategize and we get to take advantage of all of the different stuff. And you can see that the title of my presentation today, Dodging the Tax Man, loopholes, right? You know, legitimate loopholes. That's the key, is we're not ever going to encourage somebody to cheat on their taxes or to get into the red area. Certainly there's a lot of gray area in the tax code that people can debate and try to manipulate for their advantage. But that's not really what we're talking about. We're talking about understanding the rules, excuse me, as they are. Excuse me, I'll grab a drink of water. We want to be working with reality and working with the current rules and making sure that we're taking the best advantage that we can of legitimate rules. So that's what we'll be discussing today. So again, kind of a misnomer. We're not talking about dodging the tax man in an illegitimate way. We're talking about in a way that basically just uses the rules to your advantage. So today we'll jump right in. Legitimate tax loophole number one, bad debt. And so some of these you'll notice as we get going, some of these you may not have even thought of before. And I hope a lot of the value that you get today is just maybe having something get triggered that you hadn't thought of before. So today, really, you might not have any bad debts. You might not have somebody that owes you money. That's what we're talking about here, somebody that owes you money and they didn't pay you back. So as we go through here, you might think of something unrelated, and that's fine, but maybe it triggers you so you can save some money someplace else. So tax loophole number one, bad debts. Some people might not even think of this, but if somebody owes you money and they didn't pay you back, that would be a bad debt. And you actually can claim a tax deduction for that. Some people might say, well, what about loans to kids? You know, that's the one that I hear the most, is that, well, I loaned some money to my kid or to a relative, and maybe I kind of planned on them not paying me back. Maybe I thought there was a possibility of being paid back. That's where the gray area comes in, certainly, is that if the IRS would construe it as a gift, where it was meant not to be a loan, it was really more of a gift, then obviously that's not going to be something that's usable. But in some cases, somebody may have owed you money, they didn't pay you back. It is something that you can actually claim a write-off. But again, be careful that it wasn't intended as a gift. So tax loophole number 2, capital gains tax rates. I'll dig into this a little bit more because it tends to impact more people. We have a lot of clients that work in corporate America where they may receive stock as part of their company incentives, their compensation, and they can take advantage of some tax rates that were more favorable because capital gains tax rates are always lower than whatever your marginal income tax rate is. I'm going to digress for just a second to make sure we're all on the same page, that the two tax rates that kind of go back and forth with each other are our marginal tax rates, and that's what applies to ordinary income, and our capital gains tax rate. So most of our income, especially if you work for a company, most of our income comes from ordinary income, and that's when you hear about tax brackets. Those are the marginal tax brackets that as you make more money throughout the year, for example, salary, bonus, you would actually pay a higher and higher tax rate on that income the higher your income goes. Capital gains tax rates work a little bit differently because capital gains would be for any asset that you had at one point bought and then later sold. That would be taxed at a capital gain rate. And sometimes you actually get a claim a capital loss. Of course, if you bought something and it lost value, you may be able to claim a loss. But that would be buying an asset. That could be any kind of an asset, real estate or stock. Most frequently, could be other types of property, but those two would be the main ones. Also could be selling a business. If somebody sells their business, that would typically be taxed at a capital gain tax rate. Now, there's two things to be concerned about here. One of those is the percentage that you pay, but the other is that there's the concept of short-term capital gains versus long-term capital gains. So the way that the tax code is written currently is that the short-term capital gains would be for an asset that has been owned for 1 year or less. It's very important to get the timing correct because if you owned it for 1 year or less, you actually wouldn't get any kind of a tax advantage. It would be considered the same rate as whatever your marginal income tax rate would be, which for right now could be anywhere between 10 and 37%. So it actually could be quite high. With the long-term capital gain rate, that actually would be a maximum of 20% now. It depends on what marginal tax bracket you fall into. Some clients would pay zero, actually, if you are in the 12% bracket or lower, 12% lower bracket, you'd pay 0% capital gain. You'd pay 15% above that, and then if you're in the highest income tax bracket, then you would actually pay 20%. I know it can be a little bit confusing, but think of it this way, that your capital gains rate, as long as they're long-term, will always be lower than whatever your marginal rate is. So there is a tax advantage, and it's worth doing some planning around this because when you're working and you've got a higher amount of income, most likely, it's important to manage your income from a tax perspective, know where you're getting your income from, including capital gains, and planning appropriately. Using gains and losses to your advantage in your portfolio, or if you own different types of property or business, there's a lot of planning that goes into it. And for people who don't plan well, they probably leave a lot of money on the table by not thinking ahead, not understanding the rules. So that's something to think about. The other thing to think about, again, is losses. Think about losses as an opportunity to kind of eat up some gains. And oftentimes this time of year, we're having those discussions with clients. If they've taken a bunch of gains someplace else in their portfolio, for example, let's say that they had a bunch of gains earlier in the year when the stock market was doing really well, and now the market's in a correction, right? Things are way down in general. Actually, people might have some losses that they can use to offset those gains earlier in the year, but the gains and losses have to be taken in the same year to be able to offset each other, currently to be able to cross over. So you would want to do some planning. If you take a net loss, that's one thing that happens sometimes, is that people actually have net losses, meaning that you had more losses than gains. Then you actually can carry those forward into future years and use those against future gains that you might have in your portfolio. But again, something to look at right now if you haven't already, something to look at here at the end of the year. In particular, a lot of our clients do have equity plans at work, either through their small business or through their company, through stock purchase plan or restricted stock options. Those are all things that have different taxes and strategies applied to them. So we spent some time on that just because I know a lot of people have questions on that. And it's just really important to understand the rules around short-term versus long-term gains and then how the losses match up against those things over time. Again, this is about not leaving money on the table. Tax loophole number 3, again, legitimate tax loophole number 3. I'm sure we could have a presentation on illegitimate tax loopholes, right? Lots of people that try to play games. What we're talking about is just playing by the rules, understanding them. Second, home mortgage interest deduction. So that still is intact. That was one of those things that could have been nixed in the tax bill last year, but it didn't. Actually, up to $750,000 mortgage can still be used for the mortgage interest on a second home. So whether that be kind of a traditional second home or a condominium, a co-op, a mobile home, house trailer, boat, any kind of property like that, the rule basically is that it has to have sleeping, cooking, and toilet facilities. So it could be a boat, for example. If it's a big boat, then and it has those features, you may actually be able to take that mortgage interest deduction for the second home as well. So don't leave that money on the table. Something to be concerned about if you've got it, or maybe if you're even thinking about it, you might consider how you would finance those things, for example, versus paying cash or using investments to be cashed out for those things. There could be some advantages to actually taking out a loan for part or all of it. Legitimate tax loophole number 4. Let's take a look at rental income for people who have rental properties. That's one thing that a lot of people will use to kind of accumulate over time, or maybe they sell a house and upgrade to another home. They might use the first house instead of selling it and moving the equity to the second home. They might actually just hang on to it and keep it as a rental property. There are some advantages to that. Certainly one of those is income, is that you might receive income off of it. And in the current economy, where we've got such a, at least in northern Colorado right now, we've got a very, very low vacancy rate for rentals. So it's actually a really good time to own rentals. You probably have somebody occupying and paying rent. And in a bad economy, of course, it's the reverse, a lot of empty rentals, people having to cut the rent and take a much lower cash flow. Right now is kind of the sweet spot. So there can be some big advantages there as far as income. Second thing is that there could be tax deductions, right? You could take depreciation on the property, which means that you're able to take some write-offs over time of that property. You could be writing off other types of expenses. For example, if that's your business, and even if you're working someplace else, that might be your business, and you might be able to take some other deductions, or for some improvements on the property, maintenance on the property, there could be some adjustments that you would make. Sometimes people will actually do it where they buy a rental someplace where they really kind of enjoy going. For example, they might have a rental in Scottsdale, Arizona, and that's just where they happen to like to go. And so they get a rental down there, they rent it out, but of course they need to go check on it, right? They need to go check on it, make sure that all is well, and they'll use that as an opportunity to write off some of those expenses to travel back and forth for the plane tickets, for the rental car, things like that that would be needed. As long as you can show that that was legitimate, that you actually did go check on your investment and check on the upkeep of it, that could be an opportunity to take some write-off on part of that income. So the other thing that you can keep in mind is that if you rent out your primary or your secondary home for less than 15 days during the year, you don't need to include the income for the rent received. Believe it or not, you actually don't have to include that. So for example, you probably have heard out in Kentucky, the Kentucky Derby, people can get massive amounts of money for renting out their home just for a few days. So people could be taking advantage of that. Next thing, legitimate tax loophole number 5, charitable gifts. This is another thing that in December of each year, a lot of people are thinking about. I'll throw out a few things that tend to come to mind in the conversations I have with clients. One of those is thinking about giving away, instead of cash, giving away other types of assets. For example, one that clients will often look at is they'll look at if they have some highly appreciated property, for example, stock. Maybe they bought some stock through their stock purchase plan or something else, and they bought it really, really cheap. So the basis is very low on that property. If they give that away to a charity, it has to be a qualified charity, but if they give that away, they actually don't have to pay any capital gains on that when it's sold, nor does the charity, because the charity is a nonprofit. But meanwhile, they were able to give the same amount of value, maybe that they were planning on giving otherwise, and not have to pay those capital gains. In other words, transfer them to the charity. And the charity is still happy because they receive the stock and they take it, they sell it, they use the money for whatever their charitable purposes are. And you get the tax write-off when you put it in. When you give it to the charity, you actually could claim that as a charitable contribution for that year. So that's one that's very common. One thing that people are able to do now that wasn't always there, and we've seen a lot of clients start to look at this, is making a contribution to a charitable fund. So this is a little bit different because you actually can make a contribution to a qualified charity fund that you still would be able to control the gifts and who actually gets the gifts, which charities receive the gift. Keystone actually now has a connection. We've actually hooked up with Fidelity Charitable, and we actually have the ability of helping you with those gifts. And the nice thing about it is that it's a way that you can actually take property or cash, either way. You can take property or cash, put the money into that qualified charitable fund, take the deduction in the year that it was given, but you don't actually have to give the money to the individual charities until sometime down the road. So, for example, let's say that somebody was in a really high tax bracket now, but they planned on being in a much lower tax bracket next year or the following year. So the tax advantage to them could be much higher by giving the charitable gift all at once and making that contribution this year. The way that they would do that then is put all the assets or the cash, whatever it was that they wanted to, into the charitable fund. They get a tax write-off this year for all of it. And then over time, they're able to divvy that out to the different charities that they want to support. So they still have control in how it's given out and even how the money is invested once it's in the charitable fund. But they wouldn't actually be giving the gifts to the individual charities, the eventual charities, until some point in the future. So this could work well. Let's use an example. Let's say somebody had some highly appreciated stock or even a piece of property, that maybe they had a piece of land or mineral rights or something like that. They could actually donate that into a charitable fund. And again, we use Fidelity Charitable, but it could be a different organization. They would actually get that as a charitable write-off. And then maybe they decide to give that money out over the next 10 years. Maybe they give a tenth of it away each year, and every year they could choose which charities receive it. It could be more than one charity. It could be that there's a year that they skip and don't do anything, and then the year following they make a charitable gift. The one thing to keep in mind, though, is that you only get the tax write-off when you put the money in at the origin, right now. In other words, that over time you don't get another write-off when you pass it on to United Way or your church or whoever it is. So it can be really effective, again, for highly appreciated assets. They could be really the best way to be able to pass those on, not pay capital gains, and then still get the charity to be able to receive them. So definitely call us if you want to talk about that more. We know how to facilitate that and make it happen. Obviously, today is December 13th, so you would want to get going if you haven't already thought of it, if you wanted to get it done for this year. All right, loophole number 6, pets. Believe it or not, there are deductions that you can take for certain pets. Not always. For example, we just got a new puppy here about 5 weeks ago. We're not able to deduct anything related to the dog. We're not putting him in commercials or anything like that. But a couple of things that people might forget is that if somebody needed a service animal, or maybe you have a parent that needs a service animal, if it's a service animal, it actually qualifies as a medical expense, believe it or not. Also, let's say that there was a farm animal that you kept for farm purposes, for example, or a guard dog that was guarding a building or something like that. You could actually claim that as a business expense deduction. So there are some opportunities there where somebody could actually make the case that, hey, yep, it's a business deduction, it's a medical deduction. So keep that in mind if that applies to you or maybe a family member, that you could use that. Loophole number 7, state taxes. So the one thing to think about is that with state taxes, in Colorado at least, it's a flat tax. I believe it's 4.625% right now, so that changes once in a while. But state taxes actually are eligible for a deduction up to $10,000, along with other taxes, general sales taxes, real estate taxes, personal property taxes. But one big change from the past is that now you're only eligible to deduct up to $10,000 per year. So that had a huge impact on some of our clients that live in really high tax states like California or New York or Connecticut. We've got clients that just because there was a tax cut bill that was passed last year, that didn't mean that everybody got a tax cut. The eventual scenario has to be run out with every single individual. And we found that in a lot of cases, a lot of our clients actually ended up paying more in taxes than they were before. So this was not an equal deal where everybody just got the across the board tax cut. In some cases, people ended up paying more. And of course, if you've got a high income, in Colorado, we don't have a particularly high income tax relative to some other states, but it's still there, right? It's worse than if you lived in Texas or Wyoming or something like that, where there's no state income tax. But one thing to keep in mind is that you are limited to that $10,000. So that is now something that you can't deduct up until that amount. But you can also look at things like, did you buy a new car this year, new home, boat? Depending on where your taxes are, make sure you're including those things so you can take up to that $10,000 deductible. Then loophole number 8, retirement accounts. This is a huge one for our clients, many of which have different types of retirement plans, 401ks, pension plans. Could be that they are self-employed and they've got either a self-employment pension or a individual 401k account. There are all types of different options and strategies with these accounts. It's important to look at, looking at Roth versus traditional contributions, looking at your tax rate now versus what we're projecting for the future. So one thing to keep in mind is that if you're part of a company, and that could be either if you're self-employed or if you are employed by a big company, say by Hewlett Packard or something like that, you're eligible for a deductible or a traditional 401k contribution. Now, at this point, you don't have a lot of time left, right? You still need to get that in on your pay periods. If you're self-employed, you have a little bit more time where you just would need to establish the plan by the end of the year, and you could make your contributions retroactively for 2018 into next year, depending on what your tax filing deadline is. So keep that in mind, is that you want to take advantage of any free money that your company is offering. Certainly always get the free money through the matching. You want to be careful about if you're contributing to a traditional or a Roth 401k. Most employers now offer both options, and there's not really a right or a wrong. It really just depends on how much other income you've got, where you are in life, and really what we're betting on. In other words, long-term, we're betting on tax rates going up in the future or going down in the future when you're likely to use that money. The one bias I have for sure is that if we've got younger people that we're talking to, and younger is a relative term, right? But if we're talking to younger people, I would definitely say people in their 20s, 30s, 40s, there's a pretty strong advantage, I think, to making a Roth 401k contribution or a Roth IRA contribution as opposed to traditional, simply because the factor is twofold. Number one, tax rates could go up in the future, so you could be paying lower rates now. But the other thing is that there's so much time that you've got for the earnings in your portfolio to compound, that there really is a strong advantage to foregoing the tax advantage of the traditional contribution, where it would be pre-tax right now, and gain the benefit of later on being able to distribute out those assets tax-free in retirement. One other comment on this, as far as, gosh, do I do Roth or traditional, is if you don't know, split the difference. Most employers will let you do both. You could decide how much you wanted to put into each one. And for example, the limit right now, I think it's $18,500 here for 2018. I think it goes up to $19,000 next year. We just saw those numbers come out. Maybe you do half and half. Maybe you send half of the money to the Roth and half to the traditional if you're undecided. One principle that I can tell you from working with a lot of retirees over the years is there's a big advantage to having tax diversification in your portfolio. What I mean by that is, normally we talk about diversification as just having all your eggs not in one basket. In other words, where if we're going to own stocks, let's not keep it all in one stock. Let's own dozens or even hundreds of stocks to spread out that risk. Because the reality is companies go broke all the time, and you don't want to be stuck with the one that happens to go down, right? And have that be a huge part of your portfolio. So that's one thing to really be thinking about. But yeah, again, the other thing that comes into play that is tax diversification, having some different options to be able to distribute from once you're retired. Right now, the single most important thing for those of you who are still working, the single most important decision that you're making right now is how much of your compensation are you diverting out of your paycheck before you even see it, or out of your bank account? If you're self-employed, you might have a monthly contribution, but how much of that money is going away without you touching it? In other words, going into a retirement account or an investment that will grow over time. So that's really, really important. But equally important is once you retire, the single most important decision is how much are you taking out? And we all probably have heard some different rules around this, but I like the 4% rule. And the 4% rule says that we shouldn't be drawing out, if we want our portfolio to last over time anyway, we shouldn't be drawing out any more than 4% a year. So a simple example, if somebody retires with $1 million portfolio, they could take $40,000 a year out of it and probably be able to give themselves an inflation bump over time to account for cost of living increases. So obviously that's not guaranteed, but it's a pretty good rule, and it actually holds in a lot of studies, ends up holding up in most cases. So that's one thing to be concerned about. Now, of that 4%, it would be awful nice if there was some diversification of that, where we might be taking some of that 4% from retirement accounts that have already been taxed, right? So maybe we're tax-free assets that we're pulling out from a Roth contribution. Maybe there's other income that we could be paying at really low rates. Well, it would be good to pull out of the traditional IRA or the traditional 401k for that, because we're able to pay some tax at low rates. And then finally, we might have some contributions that were made to plans that aren't in a retirement account. Could be company stock, could be mutual funds or other stock portfolios that we built up over time. So as a financial planner, I can tell you that it's awful nice when we've got a client that has multiple places that we can pull from. And so we can work with their tax advisor and really look at it from a year-to-year basis to make sure that they're taking advantage of the rules. And when I can tell you, for somebody who has all their money in one basket, where it's all in, for example, pre-tax retirement funds, there's not a lot of planning that we can do because we're kind of forced to take it from only that one place. So point here, just make sure you understand the rules of the different retirement accounts, and there are many rules. There are retirement experts that's really their specialty, and that would include us, right? Because we've got a lot of clients that use retirement accounts as part of their financial planning. So with that, I'm going to open it up for questions. I know we've kind of whisked through some of these ideas, but I do want to open it up for questions that you've got. A couple other comments I'll make while we're waiting for those to queue up. By the way, we've got a chat feature and a questions feature for anybody who signed in after we started. So feel free to chime in those questions in the GoToWebinar feature, and I'll see if some of those will accumulate. We'll answer those as we go. But I will mention a couple of things. Number one, some people have asked, hey, I heard there was some tax legislation that might pass by the end of the year that could impact 2019 and beyond. It sounds like, from what I'm reading, it sounds like it's pretty unlikely that that's going to pass. It sounds pretty unlikely that we're going to see any major changes to the tax code for 2019. One thing that always is at play is not just the law, but also the interpretation of the law. So oftentimes tax professionals really don't know the final regulations, the final implementation of some of the laws that we have until far into the year. So keep that in mind. I don't think any new laws are going to pass by the end of the year, but who knows? Something crazy could happen. Other thing is that people are kind of wondering right now, where's the market going to go from here? Where are we going to see things go through the end of the year and into 2019? Because maybe my moves that I would make aren't just tax related, maybe they're investment related and risk related. So I'll speak to that just for a moment. I think personally that we actually are seeing some pretty good economic numbers. I'm not seeing evidence that the economy is really breaking down at this point. And what we call that is economic winter. Right now, I think we're in economic fall, where things are actually pretty darn good at this point. But eventually we will go into winter. We will have a recession, a pullback, a slowdown, whatever you want to call it. Right now, we're just not seeing signs of it. Yet we're in a market correction where the market is pulled back. And I can tell you that a couple principles, one of those is the market doesn't like uncertainty. So whenever there's a lot of uncertainty, especially about big things like tax rates, the Fed moves they're going to make, trade, certainly with China, these are big, big issues, and certainly ones that could impact the economy, not just in the U.S., but in the world. So, certainly the market doesn't like uncertainty. But the second principle is that market corrections are not unusual. Market corrections, by definition, will be a 10% or more drop in the market. And of course, there's lots of different markets. There's the oil market and the Bitcoin market and the stock market, and there's even different parts of the stock market. But in general, a 10% drop that we would see in those areas. 80% of the time, corrections don't turn into bear markets. A bear market is a 20% or more drop in the stock market or any market for that matter. Right now, we're just not seeing that. We're seeing it in certain companies, right? But in the overall market, I don't think it's likely. I think it's very unlikely that we would have that 1 in 5 chance that this turns into a bear market, at least in the short run. So that being said, I still think there's some growth to go. My forecast hasn't changed necessarily. Obviously, it's pretty hard to pinpoint a correction and exactly when it's going to happen, but I think we can say some really good general things about where things are going down the road. So food for thought. We'll see what ends up happening at the end of the year. I think it's somewhat likely that we'll see a Santa Claus rally that oftentimes happens in December. We haven't really seen it happen yet, but that may end up happening where we end up seeing at least an okay end to the year for the stock market. And then 2019, for what it's worth, 2019 is the third year of the president's term, and the third year of any president's term actually ends up being one of the best years, statistically at least. So we'll see if that proves out in 2019 or beyond. Obviously, it's just a statistic, which is only worth what it is. I wouldn't be making any big moves because of that, but I'm still expecting 2019 will be an okay year. That being said, again, we're probably in economic fall right now, so we don't have probably 10 years left in this bull market. It's probably something less than that, and we should be planning accordingly and controlling risk. So that being said, I don't see any questions in the queue, but certainly reach out to me individually. If you've got anything that comes up and you want to ask a question, the best way to get a hold of me is by email. And that's josh@keystonefinancial.org. And what I can also tell you is that we have webinars that come up throughout the year. I'll jump back on the camera. We have webinars that come up throughout the year, and I love to get feedback as far as what those topics should be. In other words, what I like to see is what real people are asking and what real people are getting concerned about or maybe struggling with as far as understanding a concept or understanding what strategies to use, whether it be Social Security or tax rates or how to deal with their employee benefits. So that's one thing I'd encourage you to do is to keep feeding me ideas. In other words, that if I'm getting lots of people who are saying, hey, yeah, talk about Medicare, talk about Social Security, talk about whatever, right, then that's what I want to talk about because that's what's relevant. So with that being said, I don't see any other questions in the queue, so I will let you go for the day and get on to kind of almost the week before Christmas, right? It's coming up pretty soon. So I hope the season treats you well. I hope you have a great Christmas and New Year. And I hope that 2019 treats you well. We'll see you soon. And if you have any questions, please reach out. Thank you and take care.